Okay, everyone that's saying this is going to be a controlled squeeze, please tell me how this is going to happen, because again, there's nothing indicating that a controlled squeeze would happen. First of all, that's not even possible. Let me show you something. So look at here. What is an SFT? It's securities lending, basically, securities financing transaction. Now, we already have that, right? Because we have BlackRock, Fidelity, Invesco, Schwab, Vanguard. We have all of these people and more, like Webull and Apex, lending out securities, right? Now, why would they do that? Because they can manipulate it, right? So let's go ahead and read this. Securities lending involves a loan of securities by one party to another, often facilitated by a brokerage firm. It says nothing about cash for equities. It can be you can go to a broker and have rehypothecated dog shit and borrow securities with it, and then they'll cut you a deal on the rate, because that's what happens. That's what works. Securities lending is important for several trading activities, such as short selling, hedging, arbitrage, and other strategies. Loan fees and interest rates are charged by brokerages for borrowing securities, which can vary depending on how difficult the security is to borrow. The lender of the securities receives a rebate. There's your motive. So anyways, it peaked in 2007, okay, with transactions totaling $5 trillion that year, according to the consulting firm Fanadium that reported. That gave rise to a $17 billion pot of money, consisting of interest on collateral plus subcharges for scarce shares. Now, where did that money go? In the brokers' pockets, in the prime brokers' pockets, in the broker dealers' pockets. The custodial banks and the mutual funds and institutions, they split all the rest of the profits, leaving banks and investors with 1% or less. So if you can imagine, that's just 1 year. Add up all that money over time, and that's how much money they're leaving on the table every day, because they're putting it in the pockets of these untrustworthy mofos. That, by the way, if they want to use this service by NFCC, they've already got all this shit on their books. So, again, not a controlled squeeze. So right here, this gives us an example. In an example transaction, a large institutional money manager with a position in a particular stock allows those securities to be borrowed by a financial intermediary, typically an investment bank, prime broker, or other broker-dealer. That is no longer the case. It's only the NFCC. It's member to member, sponsored member to sponsoring member, and then their agent member to or on behalf of their customer. That's it. You can't have that third party that's going to go in and take it and reloan it and then give it back and then do God knows what with it. That's how your books get unorganized. They're trying to consolidate the organization, create a traceable, trackable, and working lending service. And they can also get back money because, again, they're leaving money on the table. Now, the reason why this is not a controlled squeeze, okay, again, you cannot control a squeeze. What you can control, though, is the effects from the squeeze, like liquidity drain that they specifically highlight, like fire sale risk mitigation. Now, the reason why people think that there's going to be a controlled squeeze is because there's language in this filing that says something about controlled buy-ins. Now, if you would have looked at the definitions and realized what a buy-in was, you would have known that a buy-in pertaining to the definition, let's just go find it real quick so I can read it. It's not the buy-in that you're thinking where they go to the market and buy in shares. No, a buy-in is when it's an SFT transaction, when an agent member goes and buys the defaulting assets of the other party to prevent fire sale in the broader market. That is what it means. It doesn't mean that they're going to prevent GameStop from going up because the shorts have to cover. This is a securities lending facility. This is not a short squeeze controlling mechanism. This is to mitigate damage to the broader market in the event of a stressed market scenario, which the stressed market scenario they're referring to is not MOAS. It's the effects of MOAS. They're going to make the dominoes fall slower, as in the selling of the positions like your Teslas, your Microsofts, all those that may need to be liquidated in order to come up with the cash collateral needed to cover your shit bets. That's basically what it is. So those of you saying it's a controlled squeeze? Where? Nowhere. The only thing I've heard is because of the buy-in phrase. The term buy-in amount would mean a net amount equal to the buy-in cost, deemed buy-in cost, of the SFT securities. SFT securities, in respect of which a transferor has effected a buy-in, less the amount of the SFT cash for the relevant SFT. Just basically, it's a remedy for fire sale. It says in here, buy-ins are a remedy for fire sale, which is the selling off of the broader market in the event that stress scenario comes to fruition. That's basically it. I just want to point that out. This filing is basically all it is in a nutshell, is taking the control and all of the shit away from the broker dealers and prime brokers and putting it all in the NSCC as the central counterparty. Everything's traceable with a very strict set of rules where there can only be fully collateralized securities pledged. That's it. And for a 1-day term. We know the time frame. We know that it has to be full cash. So it's in all sense of the word, it's night and day difference from the securities lending that we see or that we've experienced thus far. Hope that made sense. Sorry for the rant. Have a good one.